Hi, everyone. So, welcome to the live stream today. Very much excited for having you as we continue with our discussion towards the ICA November 2021 examination. And I hope that everybody is doing well. I see some of you guys joining us already. You are welcome to the live stream as we continue with our discussion. And today we're going to be focusing on IAS 40 investment property as well as IAS 37 provisions, contingent liabilities, and contingent assets, and see how we can solve some questions on these how we can solve some questions on these. So if you have any questions, you know what to do. Put it in the chat for me if you are joining us on YouTube, and put it in the comment section for me also if you are watching us on Facebook. I want to hear from you. What subjects are you writing? What topics would you want me to share my thought on? What are some of the things you would want clarification on? Put all of them in the comment section for me. I'm going to read all your comments and also reply to all of your comments for you as well. Remember that if you're writing public sector, our notebook on public sector accounting and finance is available. You can get access to this with over 100 page of questions that will help you to prepare well for your examination. And also our lectures for the May IC in November 2021 is also ongoing, and you can join the lectures and be able to study directly under my mentorship at 390 Ghana cedis per paper to join our live sessions via Zoom in that case. So welcome. I see some of you guys joining. Let's take some messages real quick, then we begin. Tamba and Brima said hello. Hi, Tamba. I hope that you're doing well. Then I see Asamoah Daisy Ebenezer said hello. Hi, Asamoah. I hope that you're doing well. Augustine A. Barton said, good day, guys. Good day, Augustine. I hope that you're doing well as well. If you're watching us, make sure you give us a thumbs up on the video. Make sure you also share the video. Let us reach as many students as possible watching this live stream so that we can together reach many people and assist a lot of students together in that case. Joseph Boris is bringing in a chat there. I don't know. I think it's an emoji there. Randy Nunu said, hello, this is my first time. Wow, Randy, you are welcome to the stream. I believe that you are getting some values on the channel already, and that is great to have you on the live stream. Give us a thumbs up on the video, Randy, sorry, and make sure you share the video as well. Tracy, yeah, I see you, Tracy. You are welcome for joining us. Joseph said, hi. Hello, Joseph. I hope you're doing well. So if you are watching, you are welcome to the stream. Comment in the chat box any questions you have for me, what topics you would want me to share my thought on a lot on the live stream. And also let me know any specific questions that you have for me that you want to seek clarification on. Probably you are learning something that you want more clarification on. Put it in the chat, put it in the comments, and then I will answer all of them for you in that case. I see also Dolapo Oyi Siku. Forgive me if I don't mention your name right, okay? Hello, Dolapo Oyi Siku. You are welcome to the stream today. Doris Ehonam said, hi, Nhyira. You are doing a good job. Thank you, Doris Ehonam. I hope that you are doing well. Mau Ehonam. Okay. All right. So let's go straight up into our discussion for the day as we focus on IAS 40 investment property and answer some questions in that case so that we can see exactly what we need to do. I'm going to share my screen with you in a moment. Okay, so let me bring up my screen. Let me bring up my screen real quick. Right, so if you remember IAS 40, I mean, we've covered this extensively on the channel. Now, in case you've missed that, you can check the description to this video and you will be able to get access to the content on that, or you can check the accounting standard playlist on the channel and you'll be able to get the access that you need in order for you to study or look at the standard in full. But what I want to do on the live stream here is to solve some questions and bring back again some of the principles that you need to understand. Basically, if you remember, we made mention of the fact that when it comes to IAS 40 investment property, it is an accounting standard used to recognize non-current assets that entities control, but for which they are used for capital appreciation. Okay, so it is either the entity is using them for capital appreciation, or maybe the entity is receiving rental income. So any non-current assets that an entity has for which they are holding on for capital appreciation so that the value will go up, then they can sell it. Or better still, they rent it out under operating lease and they are receiving rental income. Then what is going to happen is that we are going to be classifying that particular asset as an investment property. Again, if you remember, when it comes to the initial recognition of an investment property, number one is that the transaction should meet the definition of an investment property. Then the cost should be reliably measured. Then also it should be probable that the future economic benefits in the asset will flow to the entity. So these are the recognition criteria that we need to understand when it comes to dealing with investment property. Then we mentioned that on subsequent measurement, what is going to be happening is that on subsequent measurement, the entity can adopt to use the cost module, or if you want, the revaluation or the fair value module. Okay, the cost module or the revaluation module. The idea about this is that traditionally, when it comes to investment property, the default treatment is that it should be carried at fair value. Okay, but then fair value is the value at which an asset can be exchanged or a liability settled between market participants in an arm's length transaction. So sometimes an asset could be there, but the entity will not be able to determine its fair value. In such cases where the entity cannot determine the fair value of the asset, the IAS 40 prescribed that the entity should carry the asset at the cost module as per IAS 16 and calculate any depreciation that has to be calculated in that regard. So basically, when it comes to IAS 40, these are the things that we need to understand in that case. However, the key objective or the key issue also about the standard is also to look at transfers. So for instance, when an entity is using an investment property, then they transfer it into an owner occupied, meaning previously this asset was being rented out to other parties, but now the entity is coming to occupy that asset. The question we ask ourselves is, how do we account for these? And we've shared these things on the channel already. Or the entity has a PPE, an owner-occupied asset. It has been accounting for this asset as per IAS 16, but now for some reason, the entity is subletting that asset into an investment property. Again, how do you do the treatment for that, and how do you look at it? We've explained these principles already, and what we want to look at is to bring up a question to see exactly how this is going to be done in that case. So the question we want to look at is transfer of PPE to an investment property. Transfer of PPE to an investment property. So let me give you the principle under this, then we can get the concept moving forward. So when there is transfer of PPE to an investment property, a number of things would have to be done by the entity. Number one, we determine the carrying amount up to the date of the change in usage. So we determine the carrying amount of the assets up to the date in the usage of the assets. Then we determine the fair value of the asset. Because remember, when it comes to investment property, they must be carried at fair value. So we determine the fair value at the date of the change of the use. Then the last thing is that any revaluation gain or loss, any revaluation or fair value gain or loss is accounted for as per IAS 16. It's accounted for as per IAS 16, property, plant, and equipment. Sounds good? So when an entity changes from property, plant, and equipment, they'll be using these assets for their day-to-day running, for their day-to-day activities, for their day-to-day operations. Then for some reason, the entity now rents out their assets and they want to receive rental income. The question we are asking ourselves is this: how do we account for this? We are saying that number one, determine the carrying amount at the date that the transfer is being made. Then we determine the fair value, which will always be given to us in the question. Then we will look at the any fair value gain or loss will be accounted for in accordance with IAS 16, property, plants, and equipment. And if you're a good student from the IAS 16 class, you know that when there is a fair value or revaluation gain, we take it to the other comprehensive income and the revaluation surplus in the statement of financial position. But if there is a surplus, if there is a loss for the first time, then it will be taken to the P&L account in that case. So this is the principle underlining when an entity changes from a property, plant, and equipment, so that is an owner-occupied non-current asset, to a non-owner occupied non-current asset. Now, I see some of you guys jumping up. You are welcome to the stream. Comment in the chat box any questions you have for me, and also give us a thumbs up on the video. It helps us a lot so the video can be pushed. Then we can reach as many students as possible. So now that we've dealt with the background and all of that, let's look at our question here. You can take a screenshot of the question in that case. So let's look at a question we have here. This question, it's coming from Financial Reporting BPP book, BPP Study Manual on Financial Reporting. That is where this question is coming from for examination up to March 2022. So let's look at it real quick. The most important thing is, as always, when it comes to dealing with financial reporting, is to take note of the requirements of the question. So it's very important for us to know the requirements of the question as per the examiner asking us. Then we must take into consideration the years in consideration for the question. So let's look at it real quick. Let's see how we can actually put the pieces together in that case. The requirement here is simple, that we should explain how the building will be accounted for in the financial statement of Capital Co. at 31st December 20X9. So make sure that you understand the thing here is we are preparing the financial statement for 31st December 20X9. That is the year ended we are preparing the financial statement for. So let's read the question and let's build some knowledge in the requirement. You ready about that? Let's go. So Capital owns a building it has been using as a head office. So keyword, they own the building and they have been using the building as a head office. Okay. In order to reduce costs, on 30th, stay with me carefully here, on 30th June 2019, it moved its head office function to one of its production centers and is now letting out its head office. Okay, so you got to be careful that the decision was made on 30th June. Now, if the decision is made on 30th June, remember our year ended is also 31st December. So if you pay attention to that carefully, it means for the current year ended 31st December 20X9, the asset has been used for 6 months, being January to June 20X9. Be careful here. So why am I clarifying that for you? I'm clarifying that for you because you must know how much depreciation that has to be charged for the year under consideration into the statement of profit or loss. That is very critical in that case. So for the current year ended under consideration, the asset was used 6 months before it was changed into an investment property. Okay, so let's go. It's company policy is to use the fair value module for investment property. Okay, so they have to use the fair value module for the investment property. It makes sense, right? But let's go. The building had an original cost of, on 1st January 20X0 of $250,000. Oh, okay. So it means that the original cost of the building on 1st January 20X0 X0 was $250,000. Okay, so let's try to build the concept, build our understanding here very well. So let me bring in my slide on that as we present this here like this. So capital, we see in that the cost of the asset. Now, you don't have to do this in the exam, but I'm putting it down just to contextualize my workings. It's $250,000, okay? And the date of acquisition of the asset was 1st January 20X0. Stay with me carefully here. Now, we are preparing the financial statement for 31st December 20X9. So the question you ask yourself is, how long has the asset been used before the entity decided to make the change? How long has the asset been used? Remember, the change is being made on this junction, 30th June 20X9. So let's work it out. If it is X0 1st January, then the asset has been used on X0, X1, X2, X3, X4, X5, X6, X7, X8, and X9. So let's go. 1, 2, 3, 4, 5, 6, 7, 8, 9 years, 6 months. Because in the X9, it is being used for only 6 months. Like I told you a moment ago, in the 9th year, it is being used for only 6 months. So you realize that the asset has been used for 9 years, 6 months. 9 years, 6 months. I hope you can get that very well. The asset was originally bought on 1st January 20X0. 1st January 20X0. So, and the year ended is 31st December. So we've used it X0, X1, X2, X3, X4, X5, X6, X7, X8. So up to X8, we have 9 years coming in. 1, 2, 3, 4, 5, 6, 7, 8, 9 years coming in that case. So the question we ask ourselves is, how do we do the calculation in that case? So stay with me and let's see how we do the calculation. Then we are told that it is being depreciated over 50 years. Okay, so the economic useful life of the asset is 50 years. All right. Then also we are told that at 31st December 20X9, that is at the end of the year, the asset, the fair value of the asset is judged to be 350,000. Okay, because remember, investment properties are to be carried at their fair value. Sounds good? So how do we present this in our financial statement so that we can answer the question that the examiner is asking us? So let's put the pieces together here real quick. So the cost of the asset is 250,000, no cost for alarm. The asset was bought on 1st January 20X0. So far, the asset has been used 9 years, 6 months. And the examiner is asking us to calculate the amount that will be recognized. So how do we put the pieces together? Stay with me and let's put the pieces together like that. We tell the examiner that we work up here. So let's bring the cost of the asset. So cost on 1st January 20x0 is 250,000. Now, please stay with me carefully. We just stated that the asset has been used 9 years, 6 months. Now, because I want to get the 6 months for the 2019, 20x9 in the statement of profit or loss, what I'm going to do is that I will do first for the 9 years, then the 6 months will come in later on. So accumulated depreciation from 1st January 20x0 to 31st December 20x8. And that is going to be 9 years. Okay, that's going to be 9 years. So how do we do with that? 250,000 over 50 times 9 years. So can I have an answer? It's like today I don't have my Casio calculator here. Can someone help me? What do we have? I've grabbed a calculator here that's, I don't know, maybe I could trust it. So 250,000 divided by 50 times 9, I'm getting 45,000. You can confirm that. Okay, Gabriel, thank you. So 45,000, take it out. And let's get a carrying amount as at 31st December 20x8. That'll be 205,000. Okay, Randy Nunu, thank you. So that is at 31st December 20x8. But remember, the decision was made on 30th June. So let's calculate depreciation to 30th June 20 x9, which is 6 months. Okay, so we're gonna have still 250,000 over 50 times 6 over 12. So let's see what we got. 250,000 over 50 times 6 divided by 12, getting 2,500. So when we less this 2,500, that gives us the carrying amount of the asset as at the 30th June that the company made a decision. And that is going to be 202,500. 202,500. So as at the date that the entity made the decision, this is the amount we are going to be having as the carrying amount of the asset. Now, unfortunately, as at the time that the entity made the decision to change, so what is going to be happening is that from 1st July to 31st December 20x9, the entity is not going to be charging any depreciation. Why? Because now the asset is being used as what? An investment property. And the entity is carrying the asset at fair value. Please note, assuming after the change from investment property to, from property, plant, and equipment to investment property, the entity is still carrying the asset at the cost module, then we will still have charged the depreciation, even though the asset is now an investment property. Even though the asset is now an investment property. So please take note of that very, very well. Take note of that very well. We will no longer calculate depreciation for 1st July to 31st December, the remaining 6 months of the year, because the company is carrying the asset at the fair value. So now that we have this, we go back to our question, and we are told that at 31st December, the company has revalued the asset to be $350,000. So 31st December, the fair value of the asset, $350,000. So the balancing figure becomes a revaluation surplus, which will go to the other comprehensive income. So let's get a balancing figure there. 350,000 minus 202,500, 147,500. You can confirm that. That will be going to the OCI about that. So this is the workings we do for this particular question, looking at the requirement that has been given to us. Note that this 6 months depreciation will be going to the profit or loss for the current year under consideration. We do not bring the accumulated depreciation. That is not what we bring. We bring the depreciation relating to the year under consideration. We bring the depreciation relating to the year under consideration. That is what we bring. So this 2,500 will go to P&L account. Then the revaluation surplus also goes to the other comprehensive income. Any questions, please? Any questions? Okay. Yeah, Sandra, I see your figures coming up. But then 22,500, where are you getting the 22,500 from? Or because I'm getting 202,500, but I'm seeing you put in 22,500 in the chat. Let me know if I am wrong or something like that, so we can correct and do the right thing in that case. So this is the workings, but are we done? No, we need to, because the examiner didn't say do this. What the examiner said was for you to state how this will be treated in the financial statement. This will be treated in the financial statements. Now, so before I go in and extract the financial statement, I think I see some questions coming up. Let me address the questions real quick as it relates to the solution that we are looking at. Augustine said, would a building that is held for a long period of time and finally sold in an ordinary course of business be described as an investment property? It was held for a long period of time. Whilst it was being held, if they were holding on it for capital appreciation so they can sell it, then it qualifies for an investment property during the period that they were holding on it. Then at the time that they decide to sell it, then it will become movement from investment property into the inventory of the organization. So that is what you need to understand about that. Then Stan Obi said, since the asset was carried during conversion to IAS 40, does this mean that in IAS 16, when asset is revalued, can we charge depreciation? Yes. Under IAS 16, when you because depreciation is always calculated on the revalued amount. So under IAS 16, when an asset is revalued, you calculate depreciation on subsequent measurements on that particular using the revalued amount. So yes, you calculate that. You calculate that. Magisa said, what if it's a loss? How do we treat it? If it is a loss, it goes to the profit or loss account. Okay, because if you remember under IAS 16, If you revalue assets and you are getting loss, it goes straight up to the profit or loss account. However, if previously you were having a revaluation surplus relating to that same asset, and subsequently there is a loss on that same asset, then the current loss will be written off against the previously recognized gain, and any excess is what will be taken to the P&L accounts. I hope that it makes sense there. Magesa. Let me know if you get that well. Okay, so any questions, please put it in the chat for me, put it in the comment for me. If you're watching us on Facebook or you're watching on YouTube, put it in the comment for me, any questions you have about this particular issue we are looking at. And also remember to give us a thumbs up on the video if you are getting some value here, and make sure you share. Let us reach as many students as possible as well, so we can assist a lot of students across. So now that we finish our workings, let's prepare the financial statement extract. I've already done the financial statement extract literally though, but let's just go through it so that you see exactly what we're talking about. Joseph is saying that, could you please repeat what exactly, Joseph Bori? What do you want me to repeat exactly? Maybe you can clarify that, then I can take that in that case. Joseph Bori. So statement of profit or loss and other comprehensive income. For the year ended 31st December 20x9. Please note that this is an extract. Okay, this is an extract. It is not a full financial statement in that case. It's an extract in that case. So we slash in our currency sign. So what did we say will be coming in the income statement? We mentioned that the thing that will be coming in the income statement will be the depreciation. So we did the workings for that, and we say the depreciation for the 6 months up to the time that the company made the decision for the current year, 2,500. That's going to come up here as the depreciation. Now remember, this is an extra financial statement, so we could decide to just leave it like that, or we could also put it in brackets. Any which way, we're still going to be correct in that case. Then you go to other comprehensive income. In the other comprehensive income, this is where we will bring the revaluation, surplus or revaluation gain. And that was from our workings, 147,500. Please note that another thing that we could have added, or that the examiner could have added in this scenario, is to bring in deferred tax. Deferred tax. Because when an entity revalue the assets like this, what happens is that it results into a taxable temporary difference. In other words, the value of the asset goes up above the tax base of the asset, or as the asset is being recognized in the books of the tax authority. For that reason, such revaluations could result into taxable temporary difference, in which case it would have been brought here and be brought there as a deduction. So assuming there was a tax rate in the question, we will apply the tax rate on the revaluation surplus figure, because we will take that as the temporary difference, the taxable temporary difference, and we'll calculate the tax and we'll deduct it from the revaluation surplus figure. So that is also another thing that you need to understand. Like I tell you all the time, the accounting standards are not in isolation. So you must know when each of them connects with each other. So you realize that you are doing IAS 40, but there is IAS 16 understanding you need. You realize that you are doing IAS 40, but there is an IAS 12 understanding you need, income tax. You realize that you are doing IAS 40, but you need IAS 2 understanding, inventories. So accounting standards are not in isolation. You don't say, I've finished learning IAS 16, I've finished learning IAS 40. No, it is your ability to be able to bring all the pieces together in a single scenario. That is how you increase your chances of actually passing the financial reporting or the corporate reporting examination in that case. So don't learn these standards in isolation. If there was tax in this question, we would have brought it up here and deducted from the revaluation surplus figure as part of the other comprehensive income, as part of the other comprehensive income. Then we go to the statement of financial position, still for the period under consideration. So statement of financial position. As at 31st December 20X9. Again, note that this is an extract. It's not a full financial statement. So we slash it in. We lock it in number non-current assets. Now we no longer have property, plant, and equipment. What we're going to have is investment property. So with the investment property, we bring the revalued amount as given to us, 350,000. In that case, then we go to equity. And under equity, we bring the revaluation surplus. Which was 147,500. Remember, assuming there was tax, we would have deducted it from this revaluation surplus figure. Assuming there was tax, we would have deducted it from this revaluation surplus figure, so that the revaluation surplus to be brought in the statement of profit or statement of financial position wouldn't have been the 147,500. It would have been 147,500 minus the deferred tax effect of it. So please make sure you take note of that very well in that case. Any questions, please? Any questions? Let me know. Any questions? Joseph, okay, you've not come up yet. If you are watching, let me know what you wanted me to repeat on. Uche Ije, who said, good evening, Nhyira. Good evening, Uche. I hope that you're doing well. Stan Obi said, what if there is over or under depreciation on conversion of IAS 16? What do you mean by over or under depreciation? Because like we said, if you convert from IAS 16 to IAS 40, I don't know, let me try to contextualize what you're trying to say though, but if we convert from IAS 16 to IAS 40 and we use the historical cost, then the asset may be depreciated. But really, there will not be any annual transfer issue if that is what you are thinking about from the retained earnings, from the revaluation surplus to retained earnings. So basically, that is not going to really apply in this case, even though the entity may be using that. But if it is, the examiner will state that for you clearly in a given question. Toby Alimi said, what is it in a loss on revaluation? What if it is a loss on revaluation? Will it still be taxed too? Yes, if we do revaluation of our assets and it happens that the value of the asset falls, what is going to happen is that it is going to result into deductible temporary difference. Okay? Deductible temporary difference, meaning that our value will now be less than the value in the tax authority's company. So that will result into a deferred tax asset. deferred tax asset, in which case the revaluation loss may be accounted for in the P&L account. If it is just the item we have, then the deferred tax asset will also be used to reduce the current year tax payable by the entity and recognized in the statement of financial position. So, Toby Alime, if you ask about the deferred tax effect, when there is a loss, yes, there will be, or there could be, a deferred tax effect if it is supposed to be done like that. Any other questions? Toby, let me know if my explanation to your question was what you were looking at. And then also, Obi, let me know if that was, I answered your question well in that case. Okay, Joseph has come with a clarification on his question. Let's take it. Did you say if management decides to carry the assets under the cost module, regardless of the change to investment property, depreciation will still be calculated as at 31st December 20X9 for 6 months? What I said was that, assuming in the subsequent measurement, the entity is still carrying the investment property at cost module, then we will still calculate depreciation using the new fair value, so that there will be depreciation from January to June, and there will be depreciation from June to December. That is what I'm saying. Because under the cost module in investment property, the entity depreciate the assets. So if they have to depreciate, they will depreciate it using the fair value at the date of the conversion up to the year ended under consideration. So Joseph, let me know if that makes sense for you, and that was what you were looking at. Then I see another question coming in from Randy Nunu. Let's take that up. If you take the tax from the surplus, do you treat the difference in the balance sheet and tax element in the profit and loss account? No. This is what you do. The tax component is deducted directly from the OCI, like we indicated here. It will be deducted from the OCI, like we indicated here, and will be deducted as well here. But that tax, if it is a tax, deferred tax liability, will be part of non-current liabilities in the statement of financial position. So there will not be any P&L issue about the deferred tax component on the revaluation. There is another question where the deferred tax liability will be splitted between P&L and OCI. But in this particular scenario, there will not be any split in that case. Probably we'll look at that question under IAS 16 and revaluation, where there is a revaluation gain and there is a deferred tax, but we need to split it between OCI and P&L. But in this particular case, the split we will not do any split. All the amounts will just be accounted for in the OCI. Does it make sense, Randy? No. Let me know. Stan Obi said, please, what type of tax is charged on revaluation surplus? If it is resulted to revaluation deficit, will it still be taxed? Yes, whether it is surplus or gain, if it is surplus, then it results into taxable temporary difference. If it is a loss, it may result into a deductible temporary difference. So if it is a surplus, it may lead us to calculate deferred tax asset, deferred tax liability. And then if it is a loss, it may lead us to calculate deferred tax asset in that case. It all depends on what the temporary difference is. If the temporary difference is a taxable temporary difference, then as a result of the revaluation, then it becomes a deferred tax liability. But if the temporary difference is a deductible temporary difference, then that results into a deferred tax asset. That is the idea about that. So Stan Obi, let me know if that makes sense for you. Toby Alime said, what will be the recognition in the financials? When you say recognition in the financials, what kind of recognitions are you talking about, Obi? I don't know the recognition you're talking about. Maybe you can clarify that for me really quick. Randy Nunu said, okay, thanks. You're welcome, Randy. Right. So I see some of you guys also coming up. You are welcome. Comment below with any questions you have, and also give us a thumbs up on the video. It helps us a lot so we can reach a lot of students. In case you've not subscribed, also remember to subscribe to the channel so that we can really reach a lot of people. Subscribing and clicking the bell notification icon means when I go live, you will be notified by YouTube. And also your subscription helps the community to grow so that YouTube can push the video so we can reach as many students as possible and assist a lot of students with what we are doing on the channel. That is the objective. I want to make sure that I assist a lot of students as much as possible. Toby Alime said, if there is revaluation loss. We've mentioned this, that where there is a revaluation loss, it depends. What is going to happen is that if it is a first time, that revaluation loss or deficit, as you put it, will be recognized in the P&L account. And if that results into a deductible temporary difference, then certainly that will also be recognized in the P&L account. So usually revaluation loss could be recognized in the tax on that could be recognized in the P&L account if it results into a deductible temporary difference. You realize that anytime I'm doing the explanation on the tax, I'm using these two words: deductible temporary difference or taxable temporary difference. It is what is available that will determine the treatment. If it is a deductible, it results into deferred tax assets. If it is, how do we call it? If it is taxable temporary difference, then it results into deferred tax liability. Okay? Any other questions for me? Any other questions for me real quick? So that is the idea about IAS 40 when it comes to dealing with the issue about movement from the revaluation from PPE to an investment property. The key thing is to be able to understand and remember how the process go or the stages we go through. You determine your carrying amount. Number one, you calculate your how do we call it? You calculate your you determine your fair value. Second thing, then any fair value gain or loss will be accounted for as per IAS 16. So like I said, do not learn the standards on their own. It is the standards are not in isolation. When you learn them together, it increases your chances of passing the exam. So that whilst you are learning, you don't forget previous standards that you have learned in that case, because they could apply and they could be used during the period under consideration. Toby Alime said, okay, thanks. You are welcome, Toby. Any other questions for me? Any other questions for me? Okay, so I would have loved to look at the second thing I wanted us to look at today, and that is IAS 37, provisions, contingent liabilities, contingent assets. But then, because of time constraints, I'm going to be concluding around here today. And God willing, tomorrow, I'll be coming your way same time, and we're going to be looking at IAS 37, provisions, contingent liabilities, contingent assets, and I'll explain the basic principles to you. Then we take some questions so you see how these actually apply to the organization. I see another question from Stanley, or Stan Obi said, is there a difference between revaluation surplus and revaluation gain? I was taught that when an asset is disposed, the gain is revaluation gain. No. When we dispose of an asset, the gain is profit from disposal. Revaluation surplus and revaluation gain are the same thing. We just use them interchangeably. Okay? But when you dispose of an asset and you make a gain, it is called profit on disposal. It is not called revaluation gain. When you sell an asset and you make profit, we don't call it revaluation gain. It is called profit on disposal. It is when you compare the carrying amount of the asset with the fair value of the asset, and the fair value of the asset is greater than the carrying amount, that is what results into revaluation gain or revaluation surplus. And these can be used interchangeably by an entity in that case. So Stan Obi, that is what you need to understand about that. Let me know if that makes sense for you in that case. Let me know if that makes sense for you in that case. So these are a number of things that you need to understand. In that case, remember that we are in the second week in our discussion towards the ICA November 2021 examination. You can still register and join us. You can check the link to the description of this video, the first link there. You can click on that and enroll at 390 Ghana cedis per paper and join us. If you have any information, also, you can send us a message on WhatsApp on the number you see on your screen. Remember, this is our notebook on public sector accounting and finance. This is going to be helping you. We have over 100-page space on past questions, critical past questions on final accounts, on ratios, on budgeting that you need to understand. So it's a combined thing. You get a manual and you get some critical questions as well to prepare well for the exam. So make sure that you get that as well. And our advanced taxation book is also available, which can be used for level 2 and level 3 because we combine it. All these are 120 Ghana cedis each, and you can get them in that case. Mageza, it's coming up with a question. Let me look at that real quick. He said, if there was a previous revaluation surplus and now we have a loss on revaluation and is higher than surplus, Mageza, I don't understand what you're saying. Okay, maybe let me try to think about what you're trying to say. Probably you have not finished the typing. So if I get what you're saying right, what you're saying here is that, for instance, let's say that, so let me see if this is what you're saying. Let's say that previously there's a revaluation surplus on an asset for, say, $20,000. And then now we have the revaluation loss of, say, $25,000. I think you are asking, how do we do this treatment? The way we do this treatment is to first write off the previously revaluation surplus. So we debit the revaluation surplus account with the 20,000. We credit property, plant, and equipment with the entire 25,000. Then the balancing figure is what will be debited to the P&L account for the year under consideration. Does it make sense? So Mageza, this is what you need to understand, and that is what you need to take into consideration. So let me know, Mageza, if that was the question you were trying to ask relating to this. Let me know if that was what you were trying to ask. Timothy A has said, Nhyira, good evening. Please, do you have an FR manual? Yes, we have an FR book. If you enroll in our full course online, you get access to my FR book as well. In that case, and the various contents that you need to get. I think we are working on a new content now, which is being given to all the financial reporting students learning under my mentorship. So definitely you'll be able to get that manual as well. But currently we don't have hardcovers available for sale, but you can get an e-version if you enroll in the course. Mageza said, yes, that was the question. Okay, so Mageza, I hope you understand the explanation I gave for the treatment. Okay, so subsequent loss will be written off against previously recognized surplus, and the excess of the loss is what will be taken to the P&L account. Meaning that if the loss is less than the previously recognized gain, there will be no P&L coming into the picture. But if it is more, then the balancing figure goes to the P&L. So that is how you do the treatment. So Mageza, let me know if that makes sense for you. Right, so these are the things that you need to understand. We're going to be continuing with these discussions to provide you with a blueprint on how you can understand these standards. And like I tell you, and I keep on telling you this, and I'll be saying this all the time, the more we solve some of these questions, the more your understanding broadens, because you realize that you are doing one accounting standard, but then there are other accounting standards that are coming to being, and your understanding is broadened up. So please don't learn the standards in isolation. Don't say, oh, I have finished IAS 16, goodbye. I have finished IAS 23, goodbye. The standards are connected with each other, and it is important for you to understand the connection that exists between the standards, because in the exam hall, when you are preparing the financial statement, you won't read a footnote and it is just one standard in place. You may not get that. You will get the standards coming in together for that period under consideration. Laura Machaka said, good evening. Good evening, Laura. Welcome. Stan Obi said, okay, thanks. You're welcome. Mageza said, thanks. Okay, you are welcome. Toby Alimi said, does that mean you will always revalue every financial year? Yes. According to IAS 16, at least entities must revalue their assets at least once a year. In other words, what it means is that you have to always revalue the assets. But you know, the revaluation will only be done if the asset revaluation can be determined, because not all assets can be revalued. If there is no ready market, then the fair value of the assets cannot be determined. If they are not market participant, the fair value of the assets cannot be determined. So even though the standard states that at least once a year entities should revalue the assets, not all assets can have their fair value determined. For that reason, what is going to be happening is that certain assets will always be carried at their historical cost because there is no fair value available. For instance, if the asset is a customed asset or a specialized asset, which means the asset will require modification before it can be used by another organization, then in such cases, such assets, there will not be ready market available. So such assets will be carried at their historical cost, less any impairment or accumulated depreciation. So Toby, if you ask, that is the clarity on that. Stan Obi said, how much is 390 Ghana cedis in Nigeria? Oh, I think you can Google that to find out about that, but I don't know. Let's see, 390 Ghana cedis in Naira. Maybe some 2,000 or 1,008 Naira also. In Naira. Yeah, I think it's about 27,000 Naira. Obi, it's about 27,000 Naira. This is currently on Google. I don't know. That is it about that. So you can check it in your country, in your exchange rate, or with your bank as well. But currently, this is what is happening here, about 27,000 Naira. Augustine Boatin said, please, I need one of the FM textbooks. Which FM textbooks? Is this the ICA FM textbooks or what? You can message later on WhatsApp and with that, and let's see what we can do. Toby Alime said, okay, thanks. All right. Jennifer Aloyo said, thank you, sir. God bless you. Amen. And God bless you too, Jennifer, for joining us. All right. So I'm going to conclude around here today. Make sure you catch me same time tomorrow, 4:30 p.m. GMT, as we continue with our discussion. Tomorrow, I'll be sharing some thought on IAS 37, provisions, contingent liabilities, contingent asset. But most importantly, I'm going to be drawing the relationship between IAS 37 and IAS 16, because there is a great relationship that exists between that, and we will see how we will do the workings for that and the various scenarios that we have to take into consideration. So it's always a pleasure coming your way, and I'm really excited coming your way and assisting you and providing you with some answers to your questions. Make sure that you stay connected and join me same time tomorrow with your questions, and with your challenges as we continue in our discussion towards the ICA November 2021 examination. So, we meet again tomorrow at 4:30 p.m. GMT. Stay safe and stay blessed. Bye-bye. Even though I said bye-bye, there is a question coming in. Let me see if I can take it. Sorry, sir, I'm new here. What if I need more help? Can I have like a WhatsApp number or something else? Yeah, there is a number scrolling below the screen. You can call or you can WhatsApp that number. There's a number scrolling below the screen. You can WhatsApp that number. In that case, 050-114-9296. If you're outside Ghana, you add a country code to 8 plus 233 in that case. But please note that my availability is limited. So if you like send me a question or something like that for me to look at, I may not get time to look at it at the time that you may want it in that case. So that is just something you need to understand, because my availability is limited, as I have to also be attending to our students as well. So Laura Machaka said, how much is 390 in US dollars? I think that should be about $48, I guess, something like that. Let's just check that out. 390 cedis. To US dollars. Okay, about $66. Laura, that's about 66 US dollars approximately. Stan Obi, the 390 in Naira was about 27,000 Naira. You can check these on Google or check with your bank if you want to make any transaction, so that you check, look at the exchange rate. So in US dollars, that's 66 US dollars. But then in Naira, it's about 27,000 Naira, as we checked a moment ago. You can just put 390 Ghana cedis in Naira in Google, and then your exchange rate will be given to you, because this is currently here. That is subject to change in that case. Okay, Charity Labi said, God bless you. Amen. God bless you too, Charity. Stanley Obi said, how do I reach you? You can reach me on WhatsApp 050-114-9296. You can see the number below your screen there, scrolling below your screen, 050-114-9296. If you're outside of Ghana, you add plus 233 to it in that case. So you could see the number below your screen, and you can send hi on WhatsApp on that. You can also connect with me on Skype at Premium Educator, and then follow me on Instagram at Nhyira Premium as well. We have content also on Instagram, summary content on various accounting standards on Instagram TV, that when you follow me on Instagram, you'll be able to get access to also and watch, because the contents are everywhere. We will make sure that we can reach you. Then our audio podcast, or our podcast, is also now available. You can check the description. There is a link there. Wherever you get your podcast at, on iTunes, Apple Podcasts, or wherever it is you get your podcast, you just search for Nhyira Premium. The name on the channel here, or the name on the Facebook page, you search for that name on wherever you get your podcast from. Then my podcast will come up, and you can get access to the audio lectures as well, so that you can be listening to them as you are doing something, and you will not be able to watch. And these helps you a lot to engage all your senses in your learning, and that increases your level of understanding, so you can prepare well for the examination. Laura Machaka said, thanks. Always a pleasure, Laura. Okay. So thank you very much for joining me. It's always a pleasure. I'll catch you same time tomorrow at 4:30 p.m. as we continue with our discussion. Stay safe and stay blessed. Bye-bye.